Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Reviva Pharmaceuticals.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. This company, it's really one of those classic paradoxes you see in biotech investing.
A paradox. Okay, how so?
To really understand it, you have to look at Reviva not as one single entity. It's more like two distinct businesses, operating under the same roof.
Two businesses.
Yeah. You have a small, steadily growing commercial platform on one side. And on the other, you have this massive, high-stakes pharmaceutical bet that carries all the binary risk.
Okay, so we need to dissect both of those.
We have to, because the current market valuation seems, well, utterly confused about which one it's actually pricing in.
All right, let's start with that commercial foundation then. That's the revenue story that's happening right now. Looking at the first quarter of 2025, their revenue came in at, $1.87 million, and that was all from their one product, Vivi.
That's right, 100% from Vivi. It's a recombinant human hyaluronidase.
Which, for anyone not familiar, is basically an enzyme that helps other injected drugs get absorbed better, right? A real workhorse in a clinical setting.
It is a very useful product.
And I know 1.87 million might sound like a rounding error in the grand scheme of big pharma.
It does on the surface.
But what's so critical here is the trajectory. This isn't flat revenue. Vivi saw a huge 16.9% surge in sales, just quarter over quarter in Q1.
That kind of momentum is key. It suggests they're really getting traction and the commercial management is, firing on all cylinders.
And that strong commercial growth is being paired with some impressive financial discipline.
Yes, they're getting this revenue more efficiently than ever before.
That's the thing that jumped out at me. Their manufacturing optimization is paying off big time. We saw their gross margin jump to, 74.6% in Q1?
Yeah, up from 62.1% just a year before. That's a massive improvement.
It's pure efficiency hitting the bottom line, turning that sales growth directly into better unit economics.
So they're proving they can execute on the product they have now. Which brings us to their financial position, at least back in that Q1 context. Things were looking pretty comfortable.
They were. As of March 31st, 2025, they were holding $44.6 million in cash and equivalents.
And crucially, no long-term debt.
For zero long-term operating debt. For a biotech, a clean balance sheet like that gives them a kind of flexibility a lot of their peers just don't have.
And at the same time, they were tightening their spending. The net loss was narrowing year over year.
Right. It dropped from about $10.68 million down to $9.02 million in that first quarter. That shows really improving control over their burn rate.
And all these steps are building towards one big target from management. Free cash flow break even by Q4 2026.
That's the timeline they've set for this commercial side of the business to become self-sustaining, to fund the regulatory monster we're about to get into.
Right. And that foundation isn't just one product. It's really secured by this multi-layered intellectual property strategy that gives them a significant competitive moat.
This is where the tech side of the investment thesis gets really interesting. They've built what's basically a patent fence around their work based on 3 proprietary biologics platforms.
And we should probably break those down because they really speak to the long-term advantages here.
Go for it.
First is pharmacoengineering. You could just think of this as a way to manufacture complex biologics, like Vivi, much more efficiently. It gives them a real cost advantage.
Okay, and then you have the platforms that open up the pipeline.
Exactly. Dimeric targeting, which is a complex way of saying they can inhibit 2 separate biological pathways at the same time. It's designed to help overcome drug resistance.
Yeah, I see. And the third?
The third is conjugated delivery. This one's key for their topical drugs because it allows for a localized, sustained release. So the drug stays where you put it and works over time.
And this isn't just some lab experiment. The IP runway on these platforms is long. We're talking protection through 2035 and in some cases even beyond.
That long-term exclusivity is absolutely crucial. And these platforms are actively driving their non-CNS pipeline assets, which really broadens their opportunity and hedges that big CNS risk.
The best example of that has to be RVX-212. This is their topical for dermatology, specifically moderate to severe plaque psoriasis, a huge market.
A multi-billion-dollar market.
Yeah.
And what's so fascinating is the regulatory acceleration they've gotten. RVX-212 recently received an FDA Fast Track designation.
Which is a massive de-risker. For our listeners, can you just quickly explain what Fast Track actually does for them?
Sure, it just accelerates the whole path to approval. It allows them to do what's called a rolling DLA submission.
Meaning they don't have to wait for all the data to be final.
Exactly. They can submit completed sections of the application as they finish them. It just speeds up the entire FDA review time. They're targeting a filing for this asset in late 2026.
A huge step. So looking ahead, what are the near-term catalysts for this side of the business? Say, the next 3 to 6 months.
There are two main ones to watch. First, the Q2 2025 earnings report. That should be around August 12th. Consensus is already forecasting revenue to hit about $2.14 million.
So continuing that strong growth trend.
That's the expectation. And the second one is a bit more speculative, but it could be high impact.
Okay.
We're looking for a potential data readout for another pipeline asset, RVX-208. This one is for NASH. That data could drop around August 2025. Positive data that would be another big validation of their platform.
Got it. So those are all important pieces supporting the core business. But now we have to pivot. We have to talk about the elephant in the room.
Brilaroxazine.
Brilaroxazine, the major value driver, the potential game changer, and the biggest source of risk. This is the story that is completely dictating the company's valuation right now.
This is why the stock is so speculative, and also why it has such immense upside. It's a next-generation serotonin dopamine modulator targeting the massive schizophrenia market.
And the clinical data they've shown so far is it's genuinely compelling. They successfully completed that 1-year phase 3 Recover open label extension, the OLE data.
And just for clarity, the OLE data is so important because it speaks directly to long-term efficacy and safety. It shows the drug works over a full year, not just a few weeks.
So what did that data show that makes this drug such a standout?
It showed sustained efficacy across all symptom domains. But critically, that includes the really challenging negative symptoms of schizophrenia.
Things like emotional withdrawal, lack of motivation.
Exactly. The things current treatments often fail to address, or they do so with really punishing side effects.
And that's the key differentiator. If you can treat those negative symptoms effectively, you are looking at a product that could fundamentally change the standard of care.
Absolutely. And the other half of that story is the safety profile. It was incredibly favorable. Low rates of metabolic issues, low weight gain, low cardiovascular problems, especially when you compare it to what's on the market now.
Which solves the huge problem of patient adherence, right? If you're not getting debilitating side effects, you're much more likely to actually stay on the medication.
It's a virtuous cycle. Better adherence leads to better outcomes, which leads to more commercial success.
So we have this highly differentiated drug with strong long-term data, and it's heading toward the regulatory finish line. The timeline here is now the most critical thing for investors to watch.
It is.
The big catalyst, the one looming right now, is that pre-NDA FDA meeting. And that's targeted for the fourth quarter of 2025.
And that meeting is not just a formality. That is the moment the FDA gives their input on the whole data package and basically confirms the path forward.
So if that meeting goes well,
assuming it goes well, the formal NDA submission for schizophrenia is then targeted for the second quarter of 2026. The moment of truth is fast approaching.
And beyond schizophrenia, this single molecule offers some incredible optionality. It's not just a CNS drug.
That's right. It's shown activity in fibrotic conditions. They actually secured a key European patent for brilaroxazine in pulmonary fibrosis. And that builds on an earlier orphan drug designation in the US for IPF.
So multiple shots on goal from one molecule.
A highly versatile asset.
Okay, now we have to hit the contradiction. The thing that keeps this stock so volatile. We talked about the Q1 financials being comfortable, $44 million in cash. But by Q3, that runway had tightened up a lot.
It's the classic biotech dilemma, isn't it? World-class science runs headlong into the reality of paying the bills. The Q3 cash balance was down to a much leaner $13.2 million.
They did do a $9 million equity raise, which helped.
It was necessary, but this is where all the risk and dilution concern comes from.
Right. But even with that tight cash situation, their operational performance stayed strong. The net loss in Q3 narrowed significantly. It dropped to just $4 million versus $8.4 million a year prior.
They cut their burn by over half year over year, while still pushing their most important asset forward. You have to respect that.
But the equity raise, while necessary to get them through the NDA milestones, it caused a big pre-market price drop. It hurt existing shareholders.
It did. And that tight cash position just makes the other key risk worse, which is the NASDAQ compliance issue.
They did manage to regain compliance on the market value of listed securities metric, which is a good sign.
It shows good management, but they still have that lingering $1 minimum bid price requirement hanging over them.
And if the stock doesn't recover on its own with good news.
The threat of a reverse stock split still looms. And that matters a lot for investor sentiment. It often spooks retail investors, even if it's just a mechanical move to stay listed.
And yet, despite all this pressure, the institutional and speculative interest is still remarkably high. Over 63% of the stock is held by institutions.
And we've seen them taking action. Persistent Asset Partners, a notable fund, reportedly boosted its position by 300%. That's sophisticated money accumulating shares at these depressed levels.
And the options market is telling a similar story. The call option volume has just surged. We're talking up 458% versus the average.
That is aggressive, highly leveraged, bullish positioning. It's a bet tied specifically to a positive outcome at that Q4 FDA meeting.
So let's tie it all together. The valuation is, well, it's a dichotomy. The stock is trading at a huge discount to its 52-week highs of around $4.28.
The market is clearly pricing in the risk, the dilution, the compliance issues.
But if you believe in the clinical data, the upside is just massive. Analysts are still highly supportive. Their consensus price targets are clustered way higher, from $333 up to $486.
That implies a potential 400 to 600% plus upside from where we are now, if the regulatory path succeeds.
A huge if. And that reinforces the main risk, doesn't it? The story is highly binary. That whole upside hinges almost entirely on the successful outcome of that Q4 FDA meeting and the NDA submission.
Which brings us back to the investment thesis. It's really two-pronged. You have the stable, growing, IP-rich commercial platform Vivi and RVX212 acting as a sort of floor.
And then you have the massive high-risk, high-reward binary play, the brilaroxazine lottery ticket.
The current valuation seems to be pricing in almost all of the downside, leaving very little value for the growing commercial base. That makes it a really asymmetric setup for an investor who can stomach the volatility.
So the critical factor moving forward is just, can the revenue from the commercial side bridge the funding gap to get brilaroxazine over the finish line? That's the whole story.
That's it. Can they complete that transformation from a high-burn biotech to a diversified, revenue-generating pharma company?
We hope this analysis was useful for you. Make sure you subscribe, like, and comment to keep up with our latest stock talks and analysis.